So Middleby Corporation just beat Q2 consensus, reporting revenue of $875.5 million and an adjusted EPS of $2.35. But they completely bombed their forward guidance, which immediately sent the stock plummeting 10% over the next 48 hours.
Yeah, a really violent reaction from the market on this one.
Extremely. So now that we have those headline numbers out of the way, let's figure out what actually happened. We've pulled their earnings transcripts, the investor slides, SEC 8K filings, and a bunch of analyst reports from, investing.com, Zacks, MarketBeat, Trading Key, plus notes from JP Morgan and Canaccord.
Right, it's a huge stack of data.
It is. And our mission for you today is to unpack this wild paradox. I mean, it's like throwing a wildly successful Michelin star dinner party, right? The food is flawless. But then, as your guests are grabbing their coats, you casually mention that for the rest of the year, the menu at your house is just going to be instant ramen.
That's a phenomenal way to frame it, because the market, or your guests in this case, completely forgets about the Michelin star meal. They only remember the ramen. Wall Street is entirely forward-looking. It's always asking, what are you going to do for me tomorrow? And this report is just a masterclass in how the market values future guidance and corporate restructuring over past performance.
Right. So to understand that stock drop, we actually have to start with the good news, right? The transformation.
Yeah, we have to look at what they actually achieved in Q2, because the headline numbers weren't just a simple beat. They were the result of this massive multi-billion-dollar structural shift.
Right, because they're now a pure-play commercial food service company, which is a huge deal.
It's a dramatic transition. I mean, for years, Middleby was running three very distinct divisions. You had commercial food service, so restaurant kitchen equipment. You had residential kitchen equipment, like those high-end luxury stoves. And then industrial food processing, which is massive factory machinery for packaging food.
Juggling all three has to be incredibly complex.
Extremely. So management just decided to reshape the whole model.
And they made some really aggressive moves to do it. Like back in Q1, they sold a 51% stake in their residential kitchen business to 26 North.
Yep.
And that brought in, what, $565 million in cash?
Exactly. Lots of cash.
But then, right after Q2 ended, I think it was July 6th, they spun off the entire food processing business into a brand new public company called MIDD, ticker symbol MFP.
Which is a huge undertaking. When you execute a spinoff like that, you're basically taking a massive chunk of your operations, handing shares to your existing stockholders and saying, this is a separate entity now.
Leaving the parent company highly focused.
Right. Middleby today is just commercial kitchens, restaurants, fast food, hotels. And in Q2, that specific core business absolutely crushed it.
They really did. I mean, they posted 8.3% organic growth, hitting about $630 million in sales. And management was saying this wasn't just a fluke.
No, not at all.
It was driven by quick service restaurants, the QSRs. Mostly their adoption of these new automated products coming in 2027, like Fizzbot and Gravity.
Right, the automation tech.
Yeah, like Fizzbot automates the whole beverage pouring and lidding process, and Gravity automatically drops and lifts fry baskets perfectly. If you're a fast food operator dealing with labor shortages, you need those.
And that tech illustrates exactly why a pure play model is theoretically so great for investors. When management runs three totally different businesses, their capital allocation is it's fragmented.
Spreading R&D too thin.
Exactly. Every dollar, every meeting is split. By becoming a pure play, Middleby can direct every single R&D dollar into their highest margin division. They can accelerate things like Fizzbot without worrying about, luxury home stoves.
Okay, let's unpack this. Because they essentially decluttered their corporate house to focus entirely on their best room, the commercial kitchen. But if the decluttering was so successful, why did the neighbors, the stock market, start complaining?
Well, because decluttering a corporate house is incredibly expensive and messy.
Right.
When you look past the adjusted earnings and dig into the GAAP numbers, the generally accepted accounting principles, you see this really ugly underbelly to the quarter.
Yeah, this is where the plot thickens for you as an investor reading this release. Adjusted EPS beat at $2.35. But the diluted GAAP EPS, which includes all the real-world messiness, plummeted down to $1.20.
Down from $1.91 a year ago.
Exactly. That is a steep drop in actual on-paper profit.
It is,
Yeah.
and it was driven by these hidden costs tied to the restructuring. First, they had $14.5 million in strategic transaction costs.
Just to get the deals done.
Yeah, you don't spin off a major division and sell a controlling stake to a private equity firm without paying an army of lawyers and bankers.
Plus, they faced higher interest, higher taxes, and a massive $28.9 million affiliate loss, which dragged down the bottom line hard.
Right. When a partner business takes a hit, those losses hit Middleby's books too. But even beyond those structural costs, their actual day-to-day operations showed strain. Their adjusted EBITDA margin shrank by 70 basis points to 22.1%.
Which doesn't sound like a lot to a layperson.
No, 70 basis points is just under 0.75%. It sounds like a rounding error. But in heavy manufacturing, losing nearly 1% of your margin on hundreds of millions in sales is a massive hit.
And it exposes the macroeconomic headwinds they're facing, right? The transcripts showed they have an estimated $70 to $80 million in annual tariff exposure.
Yeah, mostly from Section 301 tariffs on Chinese imports. So steel components, electrical controls, it all suddenly costs way more.
And tariffs are just one part. Management expects another $10 to $15 million in incremental inflation costs just in the second half of 2026.
Right, raw steel, copper, and huge spikes in ocean freight. Moving heavy metal boxes around the world is getting super expensive.
So management said they're planning a Q3 price increase to offset this. But my question is, if they knew these tariffs and supply chain costs were hitting, shouldn't they have raised prices already? It feels like they're on a treadmill that keeps speeding up, but they're too scared to increase the incline on their customers.
What's fascinating here is the mechanics of B2B pricing power. There's always a lag.
Really?
Oh, yeah. If ocean freight spikes on Tuesday, you can't just change your oven prices on Wednesday. Middleby is locked into long-term purchasing contracts with massive restaurant chains.
Oh, right. Dealer agreements.
Exactly. Lead times stretch for months. So for a quarter or two, they just have to eat the inflation. It squeezes their margins immediately until those contracts come up for renewal.
So they eat the costs, which hurts. But what's crazy to me looking at the sources is that even their sales wins hurt their margins this quarter, like the ice and beverage stuff.
It's the ultimate double-edged sword, yeah.
They saw super strong sales in ice and beverage. Normally, that's great. But those specific machines carry a margin profile about 400 basis points lower than their core cooking platforms.
Right, 4 full percentage points lower.
So ironically, because the sales team killed it selling beverage equipment, it diluted the overall profitability of the company. You sell more, but you make less per dollar.
Precisely. You combine all of that, the transaction costs, the affiliate losses, tariffs, inflation, and the bad product mix, and you get the absolute disaster that was their forward guidance.
The instant ramen portion of the dinner party.
Exactly.
So management issues their post-spin guidance. And this is key for you to understand starting in Q3. That huge food processing business is gone from the balance sheet.
Right. It belongs to Madeira.
So they guide for Q3 revenue of $620 to $640 million and EPS of $1.67 to $1.83.
But Wall Street's consensus estimate for Q3 revenue was way up at $696.6 million and EPS at $1.95.
A huge miss. And the full year 2026 guidance was even worse on paper. They guided full year revenue to about $2.48 to $2.53 billion and EPS around $6.80.
Meanwhile, the previous Wall Street consensus was expecting $2.9 billion in revenue and $8.48 in EPS.
That is a canyon-sized gap. No wonder the stock fell out of bed. Down 3.56% pre-market, closed down nearly 8% on day one, and then fell another 2.65% the next day.
Dropping from $130 down to $116.
JP Morgan slashed their price target, Canaccord cut theirs. But, and this is the big question for the deep dive, was this guidance miss actually as catastrophic as it looked?
Well, this is where we have to separate operational reality from Wall Street's reporting chaos. The miss wasn't totally an operational failure.
What do you mean?
There was massive confusion regarding those consensus estimates. Analysts at major banks build complex models, right? But when Middleby spun off food processing on July 6th, a lot of those analysts didn't update their models fast enough.
Here's where it gets really interesting. It's like, imagine a marathon runner wearing a 20-pound backpack. Right before the race starts, they take the backpack off. But when they cross the finish line, the doctors weigh them and absolutely panic because the runner lost 20 pounds.
Right. They think the runner is dying.
Exactly. But they just took the backpack off. Wall Street was comparing post-spin apples to pre-spin oranges. The consensus numbers still had the ghost of that food processing business baked in.
That captures it perfectly.
Hmm.
The baseline shifted and the automated reaction systems didn't catch up. But we can't let management entirely off the hook either.
Why not?
Because even when you manually adjust the models for the spinoff, the market still saw a legitimate slowdown in organic growth for the back half of the year. Yeah. You couple a real organic slowdown with those severe margin headwinds we talked about, and it triggered the sell-off. A perfect storm of reporting confusion and a genuinely softer outlook.
So the backpack came off, but the runner was also actually slowing down because of a headwind. Which brings us to the ultimate question for you listening today. We need to weigh the bull versus bear case.
Yeah.
Where does Middleby go from here?
Let's start with the bull case, because despite the stock taking a beating, Middleby is still a cash cow. The balance sheet is remarkably healthy.
They have, what, $2.6 billion in borrowing availability?
Yep, and their net leverage is sitting at a very manageable 2.4 times.
Meaning it would theoretically take them just under 2.5 years to pay off all debt using current earnings, right?
Exactly. In heavy industrial manufacturing, that's a very comfortable safety net. But the really compelling part of the bull thesis is their aggressive stock buybacks.
Right. They've been voraciously buying their own stock. Over the last 6 quarters, they repurchased 8.7 million shares. That's retiring 16% of the entire company.
And in Q2 alone, they bought 1.4 million shares.
Which is nearly 3% of the float in a single quarter.
And if we explain the float, it's just the shares available to the public. When a company buys back stock, the float shrinks. So if you make $100 in profit across 100 shares, that's $1 a share.
But if they buy back 50 shares, that same $100 is split among 50 shares. Earnings per share doubles without the business even growing.
Basic math, but incredibly powerful. And when you strip out the businesses they sold, Middleby's standalone core adjusted EPS actually grew 24.3% year over year.
Wow, 24%.
Yeah. By shrinking the share count while growing profits, every remaining share claims a much larger piece of the pie. It builds massive long-term per-share earnings power.
But then you have the bears. Right. They're looking at a cyclical slowdown in restaurant spending. They see vulnerability to product mix, like the ice and beverage issue, and they are terrified of sticky raw material costs and tariffs.
The bears have a very valid point. They're saying all the financial engineering and buybacks in the world won't protect you if the cost to build an oven keeps rising, and your customers won't pay higher prices.
So if you're looking at this objectively, management just bought back stock and shed weight to become a pure play. Is the market just being myopic? Are they focusing too much on short-term options and completely missing the long-term earnings power?
Well, if we connect this to the bigger picture, management has removed all of their own excuses.
What do you mean?
By becoming a pure play, execution is the only metric that matters. They can't blame a bad quarter on the residential segment anymore. They have to deliver operationally.
Right.
And the main goal they highlighted to fight inflation is SKU optimization and lean manufacturing.
Right, SKU stock keeping unit. So how does SKU optimization actually fight inflation?
It basically means management realizes they don't need 50 slightly different versions of the same commercial oven. If they cut the 15 least popular models, they don't have to buy specialized, expensive parts for them.
They streamline the factory.
Exactly. They get better bulk pricing on standard parts, which widens profit margins. By simplifying what they build, they lower the cost to build it, fighting off those tariff costs.
And if they pull that off, they're targeting 10 to 15% annual adjusted EPS growth.
The blueprint is there, but the factory floor execution has to be flawless.
They've isolated the variable. It all comes down to how well they can physically run a commercial kitchen business without distractions. Which leaves us with a final thought for you to mull over. The pure play strategy is a massive bet that hyper-focus beats diversification. But what happens if the commercial restaurant industry faces a broader macroeconomic recession next year?
Yeah, that's the real risk.
Right, because they don't have residential or food processing to fall back on anymore. Their entire ship rises and falls with commercial kitchen spending. So focus brings efficiency, but is a sharper sword really worth discarding your shield?
That is the multi-billion-dollar question for them. When you remove the safety nets, you have to execute perfectly.
It really does go back to the Michelin-starred dinner party. The food might be the best in the world, but if the economy slows down and nobody buys a ticket to sit at your table, you're going to be eating a lot of your own instant ramen.
Very true.
Thanks for joining us to solve this earnings mystery. We hope we helped separate the reporting noise from the operational reality. Make sure to follow the show for our daily earnings coverage, keep questioning the numbers, and we'll catch you on the next deep dive.